Welcome, welcome, welcome to Crashes and Taxes. I am your host for this podcast episode, Rebecca Walser, and I'm so glad to be with you. I know that my podcast has been missing, and it's not because I haven't been working, it's because I've been traveling. So I've been doing a lot of business travel these last little bit here, and that has made it very difficult for me to get the podcast. Actually, I've got a lot of people that love this podcast and will reach out and say, "Where's the podcast?" Especially because everything is going crazy right now. So I'm gonna catch you guys up on a lot of things that I should have mentioned on the last podcast and for whatever reason didn't. There's a lot of moving pieces. I was on with Fox Business today, and I was on for an extended amount of time because they wanted me to comment after Joe Biden came on and started talking about the student loan forgiveness program that he's putting into place. It was really just sort of wow, sort of shocking to be listening in live real time on national network, and then to be ready to go live with comments. And it just shows you this disconnect that we have between politicians and what's really going on economically speaking in this world. So I'm going to give you a lot of resources today that you can look up these items for yourself. We actually can even include the FOMC report that we're going to go through today. So we can attach that, or we can give it the link. I don't know if we can attach it because it's an actual PDF, but I think we can give the link as an attachment to Mr. Producer. Definitely let me know if we can include a link, and he will. So let's just start, for those of you that are new to the podcast and don't know what I'm talking about. We've gotten a lot of people referring, hey, go to this podcast. Remember too that this is a podcast. You can obviously listen to it in listen only mode. A lot of people working out right now listening to me, but also I do have slides. So if you want to go back and review the actual slides, the podcast I did a few weeks back had a lot of slides. That one was really slide intensive. I try not to make them too slide intensive, but they can be. So the first thing I want to do is I want to basically go ahead and share my screen with you, and something that I didn't talk about on the last podcast that I should have covered, and I just didn't. And so I'm going to go ahead and share my screen here with you. It's going to look a little bit layered for right now, but you should start seeing this. And you can pick this up from any one of multiple different news agencies. This is the one I just happened to pick up. I forgot to mention on our last podcast that the entire Japanese government had resigned. We've had now about 10 nations that have actually seen their government pretty much entirely resign. And we've had other nations, I'll just take this back off for a second. We've had other nations where just simply the prime minister stepped down, like in the UK, or you've seen certain members of parliament step down. We've had a lot of, to have 10 nations in any one given year have their entire government switch over. Something's happening. Something's happening outside of the United States that is a pattern that we need to be aware of. What is happening in these countries? Why are their governments stepping down? What is going on? And again, I will submit to you, this is all connected to central banks and the Great Reset and what is coming through that process that they are trying to basically bring about now. We know that obviously Holland and their farmers have an uprising. I saw in Germany, their farmers are also now having an uprising. Canada, it's not really making the news, but the Canadian pursuit of the ESG is also leading to the Canadian farmers with a future uprising that you're going to see very, very soon. So you've got a lot of nations where citizen groups, certain types of groups, truckers, farmers, depending on which groups are affected, ranchers, those that grow food, all of these groups are really in a quandary about the fact that the whole world is changing so fast that they don't have the ability to really keep up with that. Meanwhile, in the United States, Biden is announcing a $10,000 per person forgiveness of student loans if they make under $125,000 a year. So if you make under $125,000, you're going to get $10,000 wiped away of your student loans. The other thing that he said, which was really key, because I know we've scored this already, we thought it was going to be about $300 billion. However, he said there are 43, we already knew this, there are 43 million Americans that have student debt in America. 43 million people out of 330 million, 43 million have student debt. So over 10%. Now, he then said 27 million of those 43 million had Pell Grants, meaning that Pell Grants are exactly that. They're not loans, they're grants. They're given to low socioeconomic students to help them be able to afford school. Back in the 90s, it covered 80% of your tuition. Today, it only is covering like about a third of your tuition. Don't quote me on the number. It's somewhere in the 30s. So let's just say roughly a third. So that was Biden's point. But he said 27 million Americans have Pell Grants and debt, meaning that those people that had Pell Grants don't have student debt to be forgiven because they had Pell Grants. They basically had enough educational financial need to get a grant from the government, which is not a loan from the government. So this is a political situation. This is a campaign promise that Biden made. And obviously this close to the midterms, he's trying to fulfill that political obligation that he made. And yet what he didn't want to happen was people coming back and saying, well, I didn't qualify. I had such a high economic need. I didn't qualify for a loan. I got a Pell Grant. And now you're wiping away debt for these people that qualified for loans, but you're not dealing with the most aggressive economic need among us, which is the people that got the Pell Grants. So they said, all right, for the people with Pell Grants, we're going to double the forgiveness and we're going to give the Pell Grant people $20,000. But here's the thing. Biden actually said live today when he was announcing this, that 27 million Americans will qualify for that. So if you take 27 million Americans and you multiply that by $20,000, I'm pretty sure that's $5.7 billion in relief. Or I had to do the math, but I'm pretty sure this is quite a massive amount of aid, because everyone's been trying to score today this bill that has just come out, it's not a bill, it's an executive order, which Nancy Pelosi is on record saying that the president doesn't have the ability to do a re-forgiveness of debt. Although Biden says that with his Department of Education, he has the ability. But if we take 27 million Americans, literally 27 million Americans, and then we provide those people $20,000, and we simply take 27 million Americans times $20,000, and we add that up into currency, that is $540 billion. So just the people that are the ones able to get the full 20,000 on the Pell Grant, that alone is going to cost us $540 billion. We were already thinking that the ones that were going to cost us 10,000 was going to cost us 300 billion. So just from the Pell Grant alone, we're at $540 billion. Now, Biden said this is going to be paid for by all of the spending cuts and the deficit spending cuts that he's making. And that leads us then to the Fed and what's going on again with the Fed. And I want to give a shout out to James Nelson, who's a colleague, a CFP colleague actually in Florida. And he sent me a really great article that, I'm going to mention to you guys and share with you guys, and something that definitely, we should keep all abreast of. But the Fed is obviously meeting in Jackson Hole, their annual summer conference right now. And we're all looking forward to Friday morning when Jerome Powell obviously comes out and lets us know where the Fed is at and what's going on. The problem is the Fed is really between a rock and a hard place, and it's very difficult for them to come out with any sort of confidence that this is what's really going to go on for the rest of this year and then going forward. And what am I talking about? So, the Federal Reserve has basically printed out their SOMA, which stands for System Open Market Account. So the Federal Reserve, and I'm going to go ahead and share my screen with you guys again. So just so that you can see what I am talking about here. And again, until I get to the right page, it's going to be a little bit confusing. But you can see here, this is a report from the this is a Federal Reserve Open Market Operation report produced by the New York Fed. for the purposes of the Federal Open Market Committee. And this is the open market operations for last year, 2021, but you can see that this came out in May of this year. So this is a newly digestible report. And what we really want to look at is what is going on with basically their account, their open market account of where they actually deal with what they've done in the last, but this is just letting us see what's actually going on with their open market account and their buying and their selling. And the result here, and you can't really tell from this graph, but what has happened, and maybe it's just better if I just sort of explain this to you because it is difficult to see from a graph. What has happened is the Federal Reserve has bought so much that right now they have about 8.5 trillion sitting on their balance sheet. Now, in the course of raising interest rates this year, we stopped the asset purchases in March. So we really just recently stopped the asset purchases. The Fed would love to run off their $8.5 trillion balance sheet naturally by not selling or going out and into the market and dumping MBS, mortgage-backed securities, and treasuries, because obviously that will only exacerbate the problems that we've already had. They would love to get away with, they don't follow GAAP, they don't follow generally accepting accounting principles. So when you see any kind of mark to market requirement to print, to actually say, okay, what are your investable securities worth currently? Well, the 8.5 represents what the investment and the bonds what they bought them at, their face value of what they bought them at. We spent 8.5 trillion. The Fed does not want to send a report to anyone showing that the market has in fact come down about 10.25%. They have raised rates at such a fast pace that the value of existing bonds, and this is what I've talked to you guys about before, is that bonds run the world financially. That's the commercial leverage goes through bonds, not through equities. And as the Fed has raised these rates, bond values it's an inverse relationship. So as your current portfolio that's got fixed rates set in it sits and rots kind of with an old and out of date interest rate, as new interest rates get raised, new bonds can be bought with the higher return. Why would anyone want to buy this return if they can get this return? So, and if the Fed has to go out and sell bonds in the market, they're going to have to discount those bonds. Let's say that they bought bonds last year that were paying 2%, and now those bonds are paying 3%. The value of that bond gets discounted down so that the effective yield goes from 2%, which is the coupon or stated rate, to the new 3% that the Fed raised the interest rates to. So in other words, that by the Federal Reserve raising interest rates as they have created a lost value in their existing $8.5 trillion of securities of their federal open market positions. Their service open market account basically is worth about 10.25% less than it was when they bought it, meaning they've lost about 850 billion US dollars in value by buying all of this treasuries and MBS, mortgage-backed securities, and then raising rates to such a degree that they've basically clipped off a little bit more than 10% of their value. They don't want to realize these losses because they can print on supplements. Again, they don't follow GAAP. They don't have to follow GAAP. They have their own rules they follow. So they are able to print on supplements what the actual impact is of these accounts. And you can see here that, in fact, we can see that we have a substantial potential loss in their SOMA account, which is, again, chart 29 here. And this is a substantial amount of unrealized gains and losses. But really, the truth is, we've lost about $850 billion worth of value. So you have you have that as an issue that's happening. Beyond just that issue, you have the fact that the Fed is trying to figure out how they are going to continue to prop up the market while they are raising rates and doing exactly what they feel like they have to do to keep interest rates and at bay and all of the inflation at bay. So what we've really been able to determine is we think that we really need somewhere around about a 4% real interest rate from the Fed in order for this information to actually be realizable. About a 4% interest rate. So we aren't anywhere near that right now. We aren't near a 4% interest rate. So the Fed is going to have to make a decision. Are they going to, and this is the dilemma that the Fed is in. And I need you to understand this dilemma, because this is what it comes down to. Without the petrodollar being preserved anymore, what you have right now is the strength of the dollar is really a facade. It's really fake. And it is a remnant of what the world has known since 1974. So in other words, we have enjoyed the American singular hegemony of the American dollar as the sole reserve currency. We have enjoyed that really since 1974. And it was backed because of the petrodollar since 1974. When we kicked, and I say we, I mean the West, NATO, Europe, America, kicked Russia out of the SWIFT international payment system, which is a payment system of the West. It was a West-initiated payment system. When Russia got kicked out, and they are, as far as if you look at the last couple of years, the largest producers of petroleum, of crude, is the United States was first, and now we are not producing. So we're no longer first, and we're not producing a lot at all. Then you had Saudi Arabia and you have Russia. So the top three in the world, the United States, Saudi Arabia, and Russia. Because Russia is such a large supplier of both crude and natural gas, very big supplier of natural gas and crude and fertilizer and a lot of other things, this was going to be a worldwide economic shift away from the dollar, because obviously Putin, as soon as he got kicked out of SWIFT, decided, well, I'm not accepting dollars as payment any further for anything that we sell from Russia. And that's when he said, you either have to buy in rubles or gold. And Europe finally has acquiesced, and they're actually now doing these transactions in rubles and gold. But, you should really look at Germany. Germany is got massive problems, potentially on the verge, and France as well, of economic collapse. And this is because Germany has been decommissioning their coal plants and moving away from coal. And they actually are also decommissioning their nuclear power plants away from nuclear. And they've been moving towards natural gas and more of the green energies. Well, they really depend on Russia for that natural gas. And because obviously you cannot have Russia in this BRICS kind of new, silo of the world, giving natural gas to Europe, which is obviously clearly in the NATO West camp of the world, because you can't have this any further inside of dollars or euros. It has to be now in the ruble or something else. You can see that Europe does not want Germany, or any European nation for that matter, to improve Russia's economic situation and standing by continuing to buy from Russia in ruble. So therefore, what you're seeing is a shift of Europe moving to other resources to basically back up their energy supply needs. But they're telling their citizens to brace for a winter of, unfortunately, a desolate winter. And that's because they don't believe that without Russia, they have enough of an alternative source to make it. So they're really, really beholden to Russia and have to walk a very fine line between making their citizens not have heat for the winter, or, dealing with this geopolitical situation in which they're not really supposed to be buying from Russia, although they don't really have an alternative source that can fully supply their need outside of Russia. This is a big quandary for Germany, and it's going to lead to a lot of economic upheaval. Already has and will continue to, and I worry especially about Germany and France. Now, the thing that you need to understand about Germany and Japan, and I brought up Japan at the beginning of the podcast, the fact that their entire government resigned. Again, we have at least 10, maybe 12 nations now who have either had their entire governments resign or they've had their prime ministers step down and they're going to have new elections. That should say something to you. You should understand that governments around the world are calling their treasury departments and saying, we need more money. And the treasury department's response is, there's no more money coming. That is happening. We are at the precipice. We are at the precipice now of an economic collapse globally. We are here. It is now. I expect that we will see imminently, before the end of this year, massive economic upheaval. And when I say massive, I don't want to scare you. This is not an alarmist podcast. It's not. I want to give you knowledge so that you can take that and then do something with it to better you and your family. And one of the things I share with a lot of people, and I'll share it with you, is if you tell me, if someone comes to me and says, Rebecca, I have $100,000, is that good? You have to understand, I have no way of answering that question with just that information. Unless you tell me the richest person has $1 million and the poorest person has $1,000, I have no ability to assess whether a person with $100,000 is good or bad. In other words, I hope you get what I'm saying to you here, which is money is relative. Money is relative. So if you are in tune to a podcast like this and you are hearing that we really had a liquidity bank problem in the final quarter of 2019, where the Fed had to recapitalize commercial banks to the tune of $11 trillion in 2019. We were really at the end of the currency play that we have globally right now at the end of 2019. But coronavirus magically appeared on the scene. And that allowed the governments and the central banks of the world to say, well, gosh, we're in the middle of a massive global pandemic. We have to shut down and we have to just stimulate because we have got to stop the spread. We got to shut down to flatten the curve, stop the spread. And because no economic activity is going on, we have to do a ton of stimulus. In America, we did $10 trillion of stimulus. We raised our M1 money supply from February of 2020 until August of 2020 by $5 trillion. $5 trillion. We had time that we were able to buy with Corona. We were able to get another 2 years. And now we're finally at the point of reconciliation, which is why you're seeing governments around the world resign, because they understand what's coming. They understand that they don't have the ability to keep printing money and not have massive inflation. The theory of modern monetary theory, which the Federal Reserve has enjoyed really in America since 2008, they were able to successfully keep stimulating, yet keep inflation really next to nothing. It wasn't even a thing that we even talked about, thought about, worried about. We're like, inflation, what's that? All the while, since 2008, we've been putting money, more money. The Federal Reserve's balance sheet being at $8.5 trillion, that is not normal. That is not normal at all. It used to be 800 million. It has 10x'd. If the very central bank is holding as assets the very thing they're devaluing as they raise these interest rates. And the Fed is the best in the world, by the way. Remember, Germany and Japan have had negative interest rates for years now. Now, maybe some of you don't understand what that means, but normally when you let the government have your money, you put it into a CD or a money market or a savings account, they say, oh, you give us this money to use for this much time. Good, we'll give you X amount of rate of return, guaranteed. If it's a CD, something like that. If it's a money market, maybe not so much guaranteed, but the rate will fluctuate and those kinds of things. Germany and Japan have been saying, all right, we're going to hold your money for you and we're going to charge you to hold it. So you're going to pay us a storage fee, much like we go and we leave and we have, moved to a new place and we don't have enough room and we can't decide what we want to throw away. We put it in storage and we say, well, maybe we'll buy another house and we can put it in the second house, or maybe we'll move to a larger house. Well, lots of Americans, you guys, there's shows about this, about the storage units. Lots of Americans have storage units. So Germany and Japan have been the equivalent of storage and charging people to store their money because they've been in negative interest rates. As a financial concept, it's absolutely asinine. But you start to get to negative interest rates when the quantitative easing you're doing is costing so much that you actually have to charge people to do it, which is what Germany and Japan have been doing. And we worried about it last year when we had the 10 and the 2, inverted so much. We thought, are we going to get to a negative interest rate situation in the United States? The Fed does not want to run off their balance sheet because if they have to sell, they have to realize this $850 billion of losses, and they don't want to do that, nor they don't want to be accountable to do that. They don't want to show the American people that this is what they're doing, that they're having to do this. And again, they want to push us all towards this great reset. Now, that should be alarming for anyone, because if you realize with the Great Reset, it's really just the announcement of the plain facts of where the whole world is financially speaking, that we are all on the precipice of an economic ending of fiat currency that has no hard asset backing. We are at the end of that. We were again at the end in 2019. Coronavirus came on and we were able to sustain with a lot more stimulus these last 2 years. But now inflation has come. We're finally feeling the economic indicators of what these central banks have actually done to us. They're raising interest rates to get this under control. And that brings me to our Federal Reserve dilemma. And this is why we're at the end of this fiat currency. I had a client ask me, Rebecca, what does fiat mean? Fiat means it's fake, means it's not based on anything other than the sovereignty of the nation who's creating the debt. So the United States Treasury bill that is issued by the Federal Reserve is backed up by the full faith and credit of the United States government. That means that there's no hard asset back here like gold saying, okay, we'll let you convert your dollars for gold because it's a hard asset backed currency. It is not hard asset backed at all. And in fact, it is exactly as I'm explaining it. So now that we have reached to this reconciliation point, the Fed is between a rock and a hard place, no pun intended. And the reason for that is they've done the analysis and they know that in order to get interest rates really in control of inflation, they'd have to get the Fed funds rate to about 4%. So we're at a 1.75 right now. After all the rate hikes we've already had this year, we're still only at 1.75. If that gives you any kind of understanding of the scope of the continued raising of rates we'd have to see in order to get Fed funds at at 4%. So they know the analysis is they need to keep pushing. They need to keep pushing. If you look at this week in the market, you see that the second that we got minutes from the last meeting last month in August, and we were able to digest those minutes, and those minutes looked and appeared to be a lot more dovish. The market loved that. The market loved the fact that it thought that the Fed was indicating that if they get a continuous amount of indicators economically, jobs numbers, inflation numbers, if they can continue to get CPI numbers and economic job numbers that will agree, they might not have to continue their aggressive raising of rates. This was in their minutes from August. So the market loved that and thought, wait, could this be the first indication that the Fed might actually change course? And the market loves that. The problem is, if the Fed changes course and goes back to accommodative and stimulus, then the market's going to love that for about a half of a trading day, or maybe 2 trading days at the most. And then the market's going to realize, okay, the Fed isn't serious about keeping the dollar strong. And the second this market realizes that this dollar is not nearly as strong as it is perceived to be globally. Again, the best analogy I've heard anybody use, and so I had to use this because I don't know what else to use to give you an example, right? It's like if you know, and I travel a lot, so I'll use this as an example. Let's say I'm traveling and I have this outfit that I really want to wear, and it's not a dry clean only outfit, which most of my clothes are. Let's say I have this outfit, I really want to wear it in a casual setting, and I realize I want to wash it the night before I travel, and I go put it in the washer, and I fall asleep, and I just fall asleep, and so in the morning I haven't dried it, I can't take it, right? So now I need to go in and find another outfit, and let's just pretend I haven't done any laundry and all of the clothes are dirty. This is a terrible analogy, but let's just pretend. What the US dollar is right now to the global currencies of the world is it's the one that you go in and say, gosh, everything in here is dirty and a mess, and but it's my only choices. Let me pick the best. And you pick through and you figure out, is it the German mark? Is it the EU euro? Is it the UK pound? Is it the Japanese yen? Is it the Chinese yuan? What is the best of what we have? And guess what? They pick up the dollar, and the dollar has 50 years of history of being the world global standard reserve currency globally. And this is how we've bought oil for 50 years. So it's the less and the least dirty of all of the other currencies I can currently see. This one doesn't have scale. This one doesn't, like the Chinese yuan, not enough scale for the world. This one doesn't have this. This one doesn't have that. Japanese yen, the entire government just resigned this month. I mean, I've got all of these factors going on in all of these countries globally, and therefore what seems to be the beacon of strength still to this day is the US dollar. But the second the Federal Reserve switches course and goes back to accommodative and stimulus and printing money, although Congress and Biden are finding ways to have authorized an additional $1 trillion of funding this month between the Inflation Reduction Act and now the student loan relief. That's $1 trillion, over $1 trillion actually. It's actually closer now with these new numbers that Biden just gave us to probably $1.8 trillion actually. But that aside, the second that the Fed goes accommodative, the market is so short-sighted, it does not understand what the rest of the world is going to figure out economically speaking. And that is that the Fed is not serious about keeping the strength of the US dollar, because I am telling you that the lack of dollar hegemony and the lack of having a petrodollar, we aren't even backed by petro anymore because of what has happened with Russia and the Ukraine. So we don't have our dollars that have to be sold now to Germany so that they can buy oil from Russia in dollars. That's over. That's over. And it's over for a lot. It's over for the Middle East to be buying oil in dollars. It's over. It's over. It's over. The second that the world realizes that the petrodollar is over, and therefore we don't have any kind of asset tethered to the strength of the dollar, you're going to see the strength of the dollar start to come down. And that's where we start to get into real big problems. We get into real big problems at that point. And so the Fed, in my professional opinion, cannot change course, because if they start to change course, you're going to look at the collapse of the strength of the dollar. And that's a big problem. The Fed has to remain resolute, and they have to remain serious about getting inflation under control. The problem is the catch-22 double-edged sword. We know that they can't act like they're not serious about it and go back to being accommodative, which the market would love for all of 2 days. So they don't want to go that route. They don't want to lose that. But the problem is when they stay on the strength of the dollar path, they have to really raise rates. And again, I say the analysis leads us to a conclusion that we need rates to be around 4%. We need them to be around 4%. I'm not talking about the 30-year mortgage. That's already over 4%. I'm talking about the Fed funds needs to be 4% in order to get inflation under control. This is the analysis. This is what the math shows. Now, in order to go from a 1.75 rate, which you currently are at, to a 4% rate, we have to have a substantial amount of more raises on interest rates. And the problem is the Federal Reserve has already lost on an off-balance sheet way because they don't record it on balance sheet because they don't follow GAAP and they don't have to do mark-to-market. They've off balance on supplementary schedules show they've already lost $850 billion, 10.25% of the 8.5 trillion their balance sheet is currently at. And as they raise rates from 1.75 to 4, remember we've gone from 2.5 to 1.75, so we've raised 1.5 on the Fed funds so far. Now they need to go to 4, so that would be another 2.25. We've only gone from 2.5 to 1.75. We've raised 1.5. We'd have to raise another 2.25 from 1.75 to 4 to get control and to be assured that inflation is tapped down. But the economic collapse that comes from having 14 months of no interest rate raises and then going so aggressively to go from a 25 basis point Fed funds rate to a 4% Fed funds rate to really get inflation under control because how much you've put out into the economy as far as currency, to really do that would cause such massive discounts and valuations on existing bonds globally that it could in and of itself collapse the market. So I suggest that we are at the tipping point now. We are at the tipping point, and you're not going to hear most people on Wall Street talk about it because for them, they just want to pretend that we're not in the middle of a global economic financial currency change, because that means everything that they know to be true is about to change. They don't know that world without the US dollar as dollar hegemony and the petrodollar and the strength of the dollar. They don't know the world without this. So they have no prognostication. What can they say? But we're at a tipping point because the Federal Reserve either has to raise rates aggressively to get in charge and command of all the money that they've given us and all the money they put out there. And that's extremely painful, and it causes, unfortunately, it's almost economic suicide to raise rates that much, that fast, because bonds are what runs the world, and they will collapse globally. And they already are, which is why we already have so many changes across this world of leadership in multiple countries. And we see countries that are declaring bankruptcy, like Sri Lanka. The IMF comes into a country, gives them a bunch of loans to become westernized. They take all of these things, and then they have to start taxing their citizens and paying these loans back. And that is collapsing. So as the Fed becomes serious, they cause collapse of the bond market. And yet, if they revert back to being accommodative and starting stimulus back up, then the world is going to understand that the dollar is not serious and is no longer strong. And it's just becoming a banana republic currency like Venezuela. You know, in Venezuela, I was horrified once by a picture I saw of a wheelbarrow. And this is literally a wheelbarrow of cash. And it was abandoned on the street. Abandoned. An abandoned wheelbarrow full of cash that was still so worthless no one even bothered taking it home. That's what you get when you have a country that is not serious about maintaining the strength of its currency and just prints at whim. You get hyperinflation and bills that are just basically toilet paper. Miles of just printed toilet paper. So this is just, really depressing and god awful sad, and yet it's where we are. It's reality. It's reality that you will not hear if you just listen to Wall Street pundits talk about Wall Street. If you could get somebody in a room, a Wall Street pundit in a room, and really ask them to explain to you the position the Federal Reserve has backed themselves into a corner. This is all a designed thing, but the Fed has backed themselves into a corner, and I don't think it's a corner that they have either way to turn and get out of safely or happily. I don't see the happy resolution here, which is why I submit to you, they have known this was going to come after Corona, and they've been pushing for a great reset. What is the great reset? What is it? What is a great reset? Why do they talk about this in terms of currency? We need a great reset. We need a great reset. We need a great reset. We do, because our current systems are failing and they will fail completely soon enough. Period. End of story. So there has to be a great reset. There's going to be a great reset to something. What they want a great reset to, when I say they, I'm talking about the bankers of the world and the governments of the world. They want a great reset to some sort of one currency standard, eventually one currency. But first of all, the currencies will go digital. So the very first thing that's happening, and this is supposed to happen in December in America, is digital currencies, digital dollars, USDC, US digital currency. All currencies are, China announced in 2021, and I can tell you exactly the month. It was September of 2021. The United Kingdom announced in the end of 2021 that they would be moving to digital currencies. Joe Biden signed an executive order. We are to be in pilot testing mode by this December. I'm talking 4 months from now, December 2022. We are to all be moving to digital currencies. That will then give the central bank so much more control. Remember, the central bank's a private corporation. It's not a U.S. institution. That gives the central bank 100% control of your privacy, because you have no more, because now they see everything you make and they see everything you spend. So the first step in a great reset is to get everybody to centralization. Of course, in order to have centralized currency, you have to have digital verified IDs. So that gives them the digital ID that they want. They want you to have a digital ID before you even log into the internet, so that when you're making comments, there's no more anonymous comments. There's no more social media where you just go in and give your opinion because your name is Hat Lady and you have a picture of a hat on your little thing and nobody really knows who you are, so you can say what you really. By the way, I don't have that's not me. I don't know. I just made that up completely. So if you could look up Hat Lady to see if it's me, I don't even know if there is a Hat Lady. But I'm just telling you, they want a digital ID for you to even log into the internet, so that everything you do is tracked, is accessible and attached to you as a person. They can see everything you ever said, everything you've ever commented on, and it is complete and utter technocratic slavery as if we've ever seen it. So the digital IDs, you will see it's already started. They've already implemented digital IDs in other countries outside of this one. The digital IDs have to accompany central bank digital currency, because how else are you supposed to be verified? Someone could have stolen your password and at gunpoint. So we'll start with a digital ID, but then they will then say, well, that's not enough, because just what I just said, someone could bring a gun and steal your passwords. So now we're going to just make your biometrics the ID. Eventually, it will move to biometrics, and it'll be something that is physically attached to your body. Bill Gates has these new Band-Aid tattoos that basically insert these little micro nano sensors that can be read, infrared, and all these things. So they're going to start, you're going to see a huge push for digital ID, and then you're going to see a huge push for a central bank digital currency. Again, America, it's coming in December. And then from there, they will push us to biometric IDs, and you won't be able to buy or sell anything without biometric IDs. So if you have any faith at all, this sounds exactly like I'm reading from the book of Revelations, 100%. So I don't think that this is what their plan is. This is what they're wanting to come right now, because they know they're at the end of this system that we've had. Literally, this system of currency that's not backed anywhere in the world right now by hard assets. And so that's what they are pushing for, this great reset. That's what the great reset means, and also means the implementation of all of the ESG, the environmental, social, and governance standards, which really are all about green energy, moving to green energy, away from fossil fuels. I need everyone to understand something. There is a reason that the population of the world exploded to almost 8 billion people in these last 150 years. And it's purely a function of the fact that through petroleum-based fertilizers, our food production and output has astronomically grown, that has been able to sustain that level of life on this planet. Now, the very things that came out as a miracle to increase food production, that if you go back in the 50s and the 60s and the 70s, you'll see, my gosh, this is a miracle of dynamic proportions of how much we are able to increase the population of food, because it will sustain so many more mouths. What was looked at as a miracle is now looked at the very thing that's killing our planet. while we might be able to use fossil fuels to increase food output this much and feed this many people, it actually long term, with our water usage and our recycling and our air and our carbon and our methane and our fertilizer and all of these things are actually negatively impacting the environment, causing climate change. And climate change will basically mean the planet will eventually not be inhabitable. So therefore we must unwind these fossil fuel developments, certainly in the terms of fertilizer and nitrogen. And so therefore we will be producing less food. So how do you, if you believe all of those things to be true, how do you tell a population of almost 8 billion people that we need to stop producing fertilizer chemically, industrially anymore? And we need all of the farmers of the world to go back to more organic farming. And that means your yield's going to be cut in half or even just down to a third of what it was before. And that's okay because this is the ESG rules that we now have to follow. This is why you have the Holland, the farmers, the Dutch farmers raising up in Holland saying, we won't be able to feed our families, not only because we won't be able to have enough. The margin on farming is so small, not only because we won't be farming enough to make the margins that we have to make to feed, we've been doing this now for a long time, you guys. I'm talking about the 50s and 60s. So these farmers are used to, okay, make this, I produce this much and this is my profit and this feeds my family. So they're saying, we can't profit if you're going to cut our output this much. But what they don't understand is we are going to lose lives because we aren't going to be producing as much food. And this is happening all over. You've got droughts happening where ranchers have already sent next year's populace to be meat for next year. They've sent them this year because they don't have enough water and feed to feed their full populations. So how do you tell the world that we're changing over to green energy farming, and green energy means a lot less production and many, many people will die? We won't be able to support but maybe half of 8 billion people. Maybe it's 4 billion with these reduced numbers. I can tell you that their own documents don't want more than 1 billion people on the earth based on climate change. They think that beyond 1 billion people, the planet is then on a course to become used up and no longer viable. So the things I'm saying sound nuts until you realize that they put these things in writing and that this is their ultimate belief, that we should not have ever invented these kinds of, massive explosive ways to produce food and grow our population so big because it's killing, in fact, our earth, and therefore we have to unwind it and undo it. So they are actually doing that exact thing without telling people. They're just using ESG to do it. And that's why you have farmers across the globe revolting right now and saying, you're going to put us out of work. And certainly that means you're going to put a lot of people without food. So all of this is connected. All of this comes together and works towards the ultimate thing that will happen. They're expecting a reset. I'm expecting an intervention. And but I will tell you this, it's going to happen before this year is over. You will see massive things happen before the end of this 2022 year. I promise you that. And so the last piece I will leave you, which is a piece I will leave with you, because this is all so unsettling. But I will tell you from an economic perspective, we are living through the most important time in the evolution of human history. This time right now, globally, we are a globally interconnected world. We get 80+% of everything we consume in this country from Asia. I'm talking from the United States perspective. We get it from Asia. So this is a globally integrated, inseparable, cannot be dissected world. And this is about, we're on the precipice of the largest economic sequence of events that have ever happened in recorded time ever. Well, I guess the destruction of the world could be bigger. So let's put that aside because we have had that happen with the, Noah and the flood and all those things. So besides the destruction of the world, which has happened in the past, what we are living through now will be written about for many, 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 many years to come. This is the largest economic series of events that are about to happen in your lifetime, in my lifetime, and many, many, many people's lifetime. And you're here to live through it. And the piece I want to give you is that 90% of this world has no idea what's going on. They are too busy with their TikTok, their Facebook, their social media, their emails at work, their kids' soccer game, the parent PTL meeting or parent teacher meeting, school starting back, vacation, holidays coming up. Oh, we've got, cheerleading camp. I live the same world you live in. I understand. Life has become so much that all we really seem to have time for is to go to work and work enough to feed our families, plan that vacation, make it to the kids' game, and go to bed. That's all we've had time for, because that's the routine and the rut that we live in and we deal with every single day. And I have so many people asking me, Rebecca, am I going to be okay? I'm going to be okay. And I just got to tell you that the peace you have is most people have no idea what is coming. They don't have a clue, but you do. You do. And I'm assuming if you've been watching this podcast for any amount of time, you understand the things that I've gone through. And there's a lot of stuff I wish I could share with you guys. I just can't in a public forum. It's difficult. Some of the things I share with my clients are even difficult for me to share with clients, because I know they send stuff out publicly because they like my messages. And so they'll tell me, I send it on. I got to be careful what I say when I record, because these things are so unknown and so many people are going to have no clue. And so I go back to my final piece, which I want to offer you, which is, remember, money is relative. Okay. I'm assuming that you have divested yourself substantially from both equities and bonds at this point, because you've been watching my podcast and I've been telling you that we are expecting a black swan before the end of this year. We absolutely have every confidence in the world that if there was ever a time, a black swan defined is just a large, unexpected economic event that no one anticipated. So I guess it's technically not a black swan because I'm anticipating it, but I don't know what is going to be the impetus that actually triggers the event. I don't know that impetus yet. I don't know. And every day I'm searching and I'm finding it's going to happen. It's going to be triggered and it's just going to happen. But I'm expecting a large black swan. That is my professional diagnosis based on everything I've gone through. And like I said before, and I'll share with you again, one of my colleagues that work with me, and I have such a great team. My team is phenomenal. If you guys ever get to talk with them, we have such a great team. But I was sharing with her, I said, right now we're going through this, and it seems almost like, and if I've shared with this you guys before, it's just such a valid point, but it almost seems like in the midst of this, it's going in slow motion. Wow, it just seems like, okay, we had a good month, and then we had a retraction, and then we had a mean reversion month and a mean reversion month, and then July came around and let everybody be full of hope and think that this is all over. And I literally am on with Fox Business, and I'm hearing these experts in my ear saying, yeah, I think we're going to have in the market this year, the S&P at 4,700. Don't get me misquoted. I am quoting another expert that was on Fox Business with me while I was in the waiting room in the green room. And I heard them say they expect the S&P to end at 4,700 this year. Another person came around right on after them and they asked, do you agree? And they said they agreed. So I know what the world is hearing and I know what they're not hearing, and they're not hearing this message. And so relatively speaking, a lot of people might think that things have become normalized again. And I will just point out to you that, you all are probably familiar with something called a dead cat bounce. I'm not suggesting that July was a dead cat bounce by any means, because it was certainly bigger than that. But if you go back to 2008 and you look at the global financial crisis, the GFC, in America, we call it the Great Recession, but the rest of the world refers it to as the global financial crisis, interestingly enough, makes my point exactly for me, where I'm saying to you that, the whole rest of the world ebbs and flows with what is happening in this country, and that's changing, because the dollar and its significance in global transactions has changed completely. But the bottom line is, the Great Recession that we called it in the United States was really to the rest of the world a global financial crisis, a GFC, and it caused the collapse of, it was already in process, Greece, because that's when, I don't know if you guys remember, but they had their entire country basically revolting because of the austerity measures that the European Union was placing on Greece to get their financial house in order. It really was a disaster for Greece. I have a lot of Greek friends that tell me, my gosh, Rebecca, when when we joined the EU, the price of tomatoes locally was astronomical. So a lot of things happened and changed. The bottom line is, if you look back at the global financial crisis in 2008, if you look at the dot-com crash, if you go all the way back and look at the Great Depression, we have had months before those events occurred where you had a rebound month and it looked like maybe the market had gotten past it and recovered, like July looks, right? But then if you look at those time periods, you see 40, 50% losses occurred after a rebound month. That's normal. So that doesn't indicate anything. But you have to look through the good earnings season that we had for Q2. Remember, when you had Q2 earnings estimates, companies automatically bring down their estimates so that when they see things going wrong, they don't have such a terrible miss. Companies do not want to miss their quarterly projections. They don't want to do that. They want to give projections that will move the stock price because they're accurate. So people will reduce expectations. Kohl's has done it already when a lot of earnings seasons came out. They all reduced potentially, especially retail, their third quarter expectations. So with the fact that we had a really good earnings season is a good thing, but that is in relation to the fact that many companies reduced their expectations. Everybody reduced expectations after Corona. Certainly companies have adjusted expectations as we've gotten back to work and we've kind of tried to return to some kind of level of normal. So all of these things I say to you to let you see that do not allow them to make you think everything is fine and that you can get back into a normal circumstance, because they want that, right? They want as many people invested as possible. And the reason they need that is because they need people to have a lot less options. Independently wealthy people that maybe have their own business, that are able to self-sustain economically without the government's involvement, is a challenge to a government that is in a transition phase of itself, that wants to take more control over individual citizens' lives and tasks and activities. And certainly with central bank digital currency and a digital ID, we will have a lot less control and freedom. So again, they're moving us to this great reset. I believe we're moving towards a great intervention of some kind where we have a new system that we will find a lot about after all of these things happen. But the bottom line, and again, this will be my final word I will say, is you should have peace, because money is relative and most people around you have no idea what's coming or what is going on. They are still fully invested in their 401ks and dollar cost averaging in every month by contributing. They still fully have maybe their long-term bonds that they're holding. A lot of people are in the same boat and don't understand at all what is going on globally, haven't heard a thing, and therefore, relatively speaking, you're going to see a lot of those people affected, and you will still be affected, but we will be affected, relatively speaking, much less. And that's the difference, that we can take comfort and assurance in the fact that we can make some strategic moves by protecting certain asset classes and not exposing ourselves to a lot of risk exposure at this time. And again, going back to my final point, I was talking to my colleague, is that it seems like it's slow motion going through it. But I can already see the articles that will be written in 2023 about all of the financial advisors who never said a word to their clients, who never said a word about the fact that, we are no longer in dollar hegemony. The fact that the BRICS nations are moving and formally have announced, Russia and China, that they will have an alternative reserve currency for BRICS nations. The fact that Saudi Arabia and Egypt are moving towards BRICS and away from NATO and the West. They don't have any idea that any of this has happened. And I do my part. I try. I have this podcast. I have my practice. I go on television as much as I can during the week to wake up as many people as possible to what is going on economically. But people will, they have to lay in their own beds. So what you can do is like the podcast and share it with many people as you can, so they can kind of understand what's going on, why the Fed is between a rock and a hard place. That's what this title should be, the Fed between a rock and a hard place. Where do we go from here? Because that's what I'm trying to tell you. We're at the end. There's nowhere to go from here. Not from here. This whole system has to come down and we're gonna have a new system. They want a digital global currency system, digital ID with a central bank digital currency. It'll start off with every currency, every country will have its own central bank digital currency, then that will become unnecessary and pointless, and then they'll move us to regional digital currencies, and eventually their goal is to obviously get us all onto one global currency. I'm not saying that's happening tomorrow. I'm not saying it's the end of the world. I'm just saying that this is how they plan on starting it. So that's where we are. And until next time, you guys, just have faith that we are almost at the end of this thing, and I can't wait. Take care, everybody. Talk to you soon.